Yeah, we will start the session as it's already 4:03. Good afternoon, ladies and gentlemen. Welcome to ASK Investment Managers Quarterly Portfolio Update webinar. My name is Ramakrishna. I am the moderator for today's call. So it is our endeavor and responsibility to update our esteemed investors and partners on our portfolios regularly on a quarterly basis. Today, we are updating on ASK Emerging Opportunities portfolio. To update on same, we have Mr. Chetan Thacker, who is the portfolio manager for ASK Emerging Opportunities portfolio. So Mr. Chetan Thacker has total work experience of more than 16 years with 13 years plus in equity and equity research, and his expertise domain on agriculture, chemicals, metals and mining and mid-caps. Previously, Mr. Thacker has worked with company HSBC Invest Direct, NK Global Financial Services. His education qualification, CFA from ICFA University and PGD since 2015. So before going to hand over the baton to the Chetan, so I request Chetan to update on how the ASK little bit on macros and how the ASK Emerging Opportunities businesses last quarter gone by, followed by the question and answer session. So my request to all the investors and the participants who are there in the call, type all your questions in the chat box and the question and answer session. We will curate the questions and get the answers from the Chetan at the end of his presentation. Without any further delay, I would like to take out the Chetan. Please hand over the baton to the Chetan. Chetan, over to you.
Yeah, thank you, Ramakrishna. Thank you, everyone, for joining us for this quarterly update call on the Emerging Opportunities portfolio. So like Ramakrishna highlighted, the way we structured this is we'll share an update on the macro backdrop in which we've essentially operated as far as FY24 is concerned thus far. We'll also touch upon what has worked well for the portfolio, what has not worked too well for the portfolio in this period, and what have we done in terms of changes that we've made to the portfolio and reasons why we've made those changes and why certain positions are and why we continue to hold on to certain names which have not done too well as far as this fiscal year is concerned. So to start with, coming to the macro backdrop. So the macro backdrop for FY24 has been a mixed bag. What we've clearly seen is that capex-driven businesses have witnessed volume growth, largely driven by the implementation of capex from the government side, which had increased the capex budget by 25% in the last fiscal, and that implementation has caught on stream as the year has gone by. A clear evidence of that has been in terms of the gross fixed capital formation, a contribution to GDP there has increased. We've actually seen that segment of the GDP grow at a faster rate of 10.3% thus far in FY24, as compared to the GDP growth of 7.3% that we witnessed so far in this particular fiscal. What this has meant is that we've actually seen businesses which are closely related to implementation of capex have witnessed volume growth across the board. Signs of that are visible when you look at the steel consumption demand and the cement demand, which has grown by 9 to 10% in volume terms in FY24. Similar trends would be visible in something like a cable and wire company, which is more exposed to the capex side as well, where we've actually seen volume growth remain strong upwards of 10%. The interim budget, which has just gone by, that continues to point towards capex intensity remaining high. The outlay has been pegged at 11 trillion as far as FY25 is concerned, which is an increase of 10% on the 25% increase that we witnessed last year. Our expectation is once the elections are over, we will obviously see a full-fledged budget being announced by the government, and the focus should continue to remain on the capex side, as we need fair degree of investments on the infrastructure side to provide a further foundation to accelerate growth from a longer term perspective. Coming to the weaker part, as far as the macros are concerned, we've actually seen a very adverse monsoon in this particular fiscal. That has essentially had two implications. One is food inflation has remained high, which in turn has kept inflation still to some degree elevated. The second impact is obviously on the weak rural income, which has remained under pressure. which has clearly meant that consumption to a certain extent has remained weak. A clear indication of that is particularly when you look at the private final consumption expenditure, the growth there has been subdued at 4.4%. So clearly the torchbearer for growth this fiscal so far has been the gross fixed capital formation, while consumer spend continues to remain weak. Volume growth, particularly across discretionary, has remained weak because this is a segment which is very closely linked to how incomes pan out, and we've actually seen a weaker rural income environment driven by impact on yields, while that to certain extent has got compensated by higher food prices, but there remains a fair degree of drag as far as the income growth on the rural side is concerned. On exports also, that has been a leg that has remained weak in this fiscal. Clearly, the reasons are threefold. One is the global macro environment itself, which has witnessed some degree of slowdown. Second is increased competition from China. We've actually seen China continuing to dump a lot of inventories across industries at lower prices, which has meant that revenues in turn have remained weak, impacting margins as well for exporters. While in certain industries, there has been a clear impact on the volumes as well. The third aspect has been the entire inventory destocking. The inventory destocking can be broken down into largely two factors. One is inventory correction that has happened primarily on account of normalization of supply chains. So as supply chains have moved back from 65 to 30 days, we've actually seen some degree of inventory destocking there as supply chains have normalized. The second impact is also because of cost of capital itself going up, which means that inventory holding cost has increased, and most of the global companies have retorted to reducing the inventory carryovers that they have in order to reduce that impact of higher capital cost. There is one silver lining that we are witnessing currently here. One is the fact that end consumer demand has not been as impacted as the entire inventory destocking which has been impacted. So our expectation is at some stage you will start to see recovery that happens on the export front, particularly on volumes. As far as pricing is concerned, our expectation is that you will now, from here on where we are in terms of prices, you will either start to see some degree of stabilization there with a gradual improvement as we roll ahead, and a lot of this inventory pain, which is emitted from China, starts to abate a bit, and you start to see pricing environment also improve. Having said that, a key risk remains in terms of geopolitical risk, what we are witnessing on the Red Sea side, which has meant that freight costs have gone up. On the flip side, this also means that given the longer transit route that most of the cargo now needs to take, particularly those which are heading towards Europe, that essentially means that the supply chains which had got reduced back to more normalized level can see some degree of expansion, which in turn provide a near-term fillip as far as volume recovery on the export side is concerned. So this is the macro backdrop in which we have operated in this particular fiscal year. Coming to the portfolio, what has worked well for us in this particular fiscal clearly is industrial consumables, telecom and pharma. These have been pockets where we've actually witnessed fair degree of earnings delivery. In pharma in particular, the delivery has been better than expected. And we've actually seen this part of our portfolio perform well as far as the construct is concerned. So consumables have given a cumulative return of 70%. The manufacturing export exposure in the portfolio has given a return of close to 53%. The telecom exposure has given a return of close to 78%. Pharma 48, staples 63. So this is broadly the pockets for our portfolio, which has essentially done well for us in this particular fiscal. Coming to this slide, this broadly talks about the sectors and segments from which we've actually seen a drag as far as performance in this fiscal is concerned. So two or three things clearly stand out and which are very closely linked to the macro backdrop that I just shared. So consumer discretionary has remained weak in this particular fiscal. Chemicals is another pocket that has remained weak because it's both driven by pricing pressure from China. Fact that exports have been lower in volume terms, that has also had an implication as far as exports and the chemical exposure of the portfolio is concerned. NBFCs has been another pocket. Both PSUs and NBFCs, we had a lesser exposure compared to the benchmark, where things have panned out better, and that in turn has impacted our performance adversely. Coming to why we continue to hold on to these sectors, which is all the more important, is the fact that while on chemicals, we are actually seeing slowdown as far as revenue is concerned. and margin pressures, particularly because of how pricing has behaved. What we are picking up in our interactions with most of the managements and across the industry is that the inquiries continue to remain elevated. Capex and intensity by these entities continues to remain elevated, pointing towards the strong structural tailwind that is visible on the chemical space. If you were to zoom out a bit and look at these sectors from a more macro perspective, clearly these are sectors which we believe from a more medium to long term will outperform as far as growth is concerned. While in the very near term, we are actually witnessing the shorter cycle, down cycle within a more structural up cycle. So we have continued exposure in this particular pocket because we believe that medium to long term tailwinds remain very strong. We are not seeing any slowdown as far as the inquiry pipeline is concerned or the capex intensity is concerned, which points more towards a revival as we head into FY25 as these headwinds turn into tailwinds as we move into the next fiscal. Similarly, on the consumer discretionary side, this has been a pocket which has got impacted, particularly given how incomes have behaved in this particular fiscal year. While again, similar to chemicals, this is a more structural theme. We believe acceleration will happen on the discretionary side. We've preferred consumer discretionary within the entire consumer exposure simply because they provide two great opportunities to participate in. One is penetration-led growth as the income moves up, as the country becomes richer. And second is a play on premiumization as well. So you get a combination of both penetration-led growth plus premiumization as far as consumer discretionary is concerned. We are actually utilizing the slowdown on the consumer discretionary side as an opportunity to see where else can we participate because we believe this is a more short-term negative cycle that is playing out in a more broader macro structural upcycle that will play out on the consumer discretionary side. On the financials, I think our exposure has been dragged primarily because of lower allocation compared to the benchmark on NBFCs and PSUs, which have done relatively better, particularly the PSU banks. On this particular pocket and segment, while we've increased exposure on the PSU side over the course of the last fiscal, from a more segment perspective, our expectation is we've actually seen a first leg of very fast re-rating as far as PSUs are concerned, as ROEs normalized much faster than anticipated, primarily driven by how the rate cycle has behaved and how RBI has tightened and the extent and shorter time duration in which the rate cycle moved upwards, which provided them benefit as far as NIM expansion is concerned, which along with the lower provision meant that ROE normalizations happened faster. As we look ahead, clearly on the lending side, our expectation is that NIMs will start to come under pressure, primarily driven by a higher cost of fund. The lever then available remains of cost to income, as you will also start to see normalization on the credit cost side as we move ahead into the fiscal 25. Stretching this a bit from a more medium to long-term perspective, our assessment is any business which has a structurally higher ROE can structurally grow at a rate faster. And this is a pocket or segment where we've always focused on and we continue to focus on. Having said that, within the areas that we like, we've actually increased some degree of exposure on PSUs, even on the lending side of things, where we felt there was an opportunity and it fits in with our philosophy of more structural growth playing out in that particular pocket. The third factor is PSU under ownership per se, which has impacted performance in this fiscal. So if you look at the table below, what is clearly visible is if one were to compare ownership-wise performance in the index itself. So we've actually seen family-owned businesses deliver a return of 42%. MNC has delivered a return of 22%. The pocket which clearly stands out is the entire PSU performance. So we've actually seen a 77% return delivery with an index weight of 10% on PSUs. So this under allocation there is what has also hurt us. Having said that, what we've done in this particular fiscal is there are 2 or 3 things which we've clearly done and moved the portfolio in the direction where we wanted the portfolio to move to strengthen it in terms of character. We've actually increased weight in automotive in this particular fiscal because we believe that tailwinds continue to remain there, both in terms of how we expect domestic demand to recover, coupled with the fact that there are opportunities on the export side which the automotive space can participate. And that is where we've actually increased allocation as far as that particular segment is concerned. Energy is one pocket where we've actually increased weight, and this is the oil marketing companies. This is one pocket which has also helped increase weight on PSUs. We continue to believe that as we look ahead, we will actually see GRMs remaining higher than what we've seen in the past few decades. Couple of factors there. One clearly is that we've seen a lot more refineries shut down, which means supply side remains favorable. The second aspect is most of the OMCs have actually witnessed a capex cycle, which means that their slate has become more complicated, which in turn should provide a higher GRM along with better efficiencies, as these are newer plants that come into operation. Healthcare is another pocket where we've actually increased weight to some degree over the course of the last 1 year, and defense is the fourth pocket where we've actually increased weight. So if we were to look in the hindsight, we were close to negligible weight in PSUs, while the benchmark had a average weight of 10% in this fiscal. We've actually increased the allocation there, and we've taken that weight to closer to 11% in the portfolio. Defense was a segment which was missing, where we've actually increased allocation to 4%. Automotive is where we've actually added weights, and we've increased allocation there. Just to step back a bit and look at what we've done in terms of actions in the portfolio, clearly there are 2 or 3 things which we've kept in mind as we've made these changes. One clearly is where we believe the medium to long-term growth will remain higher. That is more in the pockets of manufacturing in the portfolio, more in the pocket of consumer discretionary, where we believe that structurally growth can remain elevated and accelerated as the country becomes richer. Within PSUs, we've been very selective, sticking to names which fit our investment philosophy, and we've actually taken exposure in those particular names in the portfolio where we believe the growth can remain higher for a longer period of time with good quality of businesses. So we've actually been very selective on the exposure on PSUs that we've taken. Cumulatively, we've seen an increase in churn as far as the portfolio is concerned. The reason primarily has been we've become more agile during this period, and we've taken or we've utilized more opportunities in this period to rejig the portfolio. One, to wean out pockets where we felt the performance could have been impacted in the near term, and structurally where we believed growth will remain elevated. Having said that, our expectation is as we look ahead, compared to historically, there can be some degree of higher churn as we look to capitalize on certain opportunities from a more near-term perspective. We've actually taken some degree of flexibility within our overall framework to say that within the constraints that we operate or within the chosen pocket where we operate, where can we optimize better? And that is what we've tried to do. So you'll actually witness some degree of higher churn that has been there in this fiscal and can be a factor as we move ahead as well. The idea clearly is to catch up on the performance while keeping the more medium to long term in perspective and playing in pockets and themes which we believe are more longer term themes which will play out over a more medium to long term perspective. This slide talks about on a cumulative basis what has happened in terms of positioning of the portfolio. So you'll clearly see the weight has gone up on infra and engineering, where the weight has increased over the course of the last fiscal. Consumption is a pocket where we've actually seen some degree of reduction in weights. We've optimized that bit of exposure. Automotive, as I highlighted, has been a pocket where we've increased weight. Healthcare remains broadly steady. Energy is a pocket where we've actually added weight. Where these weights have essentially come out from is clearly TNT is one bit where we've taken some weights off, and some weights have come off on the consumption retail side. The idea still continues to remain to optimize the consumer discretionary portfolio, and that will probably be an area of focus as we look ahead, because what we expect is at some stage you will see discretionary a part of the market start to perform in terms of volume, and we are utilizing this current weakness that we are witnessing driven by macros to build positions in that particular pocket and strengthen the portfolio more from a medium to long term perspective. Coming to the third quarter results that have just gone by, one thing that stands out and is clearly linked with the macro is the fact that volume growth for discretionary has remained weak along with exports, while automotive, capex-driven businesses and pharma have continued to perform well. IT has witnessed a muted performance in line with expectation. What has done well is the pharma bit of our portfolio, and in general, the sector itself, where we've actually witnessed stable volumes, coupled with the fact that lower input costs have provided a margin lever there that has meant that operating profits have witnessed a faster growth as far as pharma is concerned. Within the automotive space, interesting things that are playing out. We've actually seen pent-up demand play out on the two-wheeler side. So we've seen recovery in volumes on two-wheelers, coupled with a lower input cost that has meant that operating profits there have inched much faster than the volume recovery that we witnessed. Similarly, on PV, we've actually witnessed volumes remain stable as far as growth is concerned, but we've actually seen the benefit of lower input costs and some degree of operating leverage because of higher volumes playing out as far as margins are concerned. Within automotive also, there are certain pockets which have remained weak. What we are witnessing is the entire MHCV bit is starting now to see some slowdown as far as growth is concerned. Our expectation is as we move into next fiscal, this pocket can see subdued volume growth play out. Tractors, which is very closely linked to what is happening on the rural side, has remained weak. So tractors at an industry level will probably end at a degrowth of closer to double digit in this particular fiscal. Our expectation is as we head into next fiscal, monsoon will play a determinant as far as the recovery on the tractor side of the exposure and automotive is concerned. Consumer discretionary, on the other hand, has remained weak in terms of volume. We actually saw post-festive demand remaining weak, and it did not pick up as anticipated, primarily driven by how incomes have played out as far as the rural bit is concerned. While there has been some degree of inflationary pressure, which has also impacted ability to spend on discretionary items, and that has had a ramification as far as the earnings delivery on that particular pocket of the market is concerned. On the financial exposure, as we look ahead, our expectation is NIMs might come under pressure as cost of funds start to catch up. What we expect is that as the rate cycle is closer to peak, you will not get the advantage of rate expansion, which had helped in NIM expansion in the last fiscal. Provisions in the third quarter have helped a bit to aid bottom line performance, but as we move ahead into the next fiscal, our expectation is that lever will also start to move off, and cost to income will remain the only lever that can be optimized as far as the delivery of performance on the lending side of the business is concerned. While on the non-lending side, anything which was linked more to capital markets has done well, given how capital markets have behaved. We've actually seen that bit of exposure continuing to do well. On the NBFC side, our expectation is whenever you start to see interest rates going down, you will actually see some degree of positive impact of that playing out on cost of funds, which in turn should aid in improvement on NIMs, but probably we are 2 to 3 quarters away from that particular scenario playing out. So this pocket, our expectation is earnings growth will probably be lower than the loan growth that we expect at the system level, primarily because of the fact that two key levers are missing, which is NIM expansion and the lever of lower provisioning. So you'll actually see cost of funds turning adverse. You will see normalization in provisions. If you look at the cumulative performance for the portfolio as a whole in this particular in this particular quarter, we've actually witnessed 17% operating profit growth, while the Nifty X of OMCs has seen a 9% operating profit growth as far as third quarter is concerned. For FY24 as a whole, we expect operating profit to be higher by 28% for our portfolio, while for FY25, this number stands at 26%. One thing that I would like to point out as far as FY24 performance is concerned, a large part of the operating profit growth for this fiscal was primarily driven by an adverse base of first half of the last fiscal. So that meant that first half of this fiscal essentially witnessed normalization in margins, which to a large extent drove operating profit growth, while volumes continued to remain muted. This composition changes as we move ahead into FY25. We expect delivery to be more driven by volume-led delivery, which in turn will mean that operating profit growth will be a function of volume-led delivery, one. And second, the fact that operating leverage, which kicks in with a volume-led delivery, and that should contribute to the 26% operating profit growth, which is expected in FY25. Coming to how the portfolio is positioned. So in terms of market cap, the portfolio today is close to 66% invested in mid caps, close to 12% invested in small caps, and just 22% exposure is on the large cap side. While the BSE 500 composition is 92% is large caps, 7% is mid caps, and a negligible on small cap. If we were to look at this bifurcation from a more mid cap index perspective as well, we essentially see a large cap contribution there of closer to 23-24%. So our exposure is a tad bit lower than what is there on the benchmark. We continue to remain focused on the mid cap and small cap side of the market. That is where this product is positioned, and that is how we are positioned. Coming to the psychographics, what stands out clearly is that you will see an ROC improvement as we head into FY25, primarily driven by the fact that volume-led recovery is anticipated to play out in FY25. EPS growth should be stronger at 35% for FY25, while for FY24 that number stands at 24%. From a valuations perspective, what is interesting is if we were to look at the portfolio valuations on both 1 year and 2 year forward, what has happened over the course of last 2 fiscals in particular, and to a large extent this fiscal as well, is that our portfolio companies have continued to deliver an operating profit growth, while the performance to that extent has not been commensurate with the delivery on earnings. That in turn has meant that from a valuation perspective, we've seen a fair degree of correction as far as valuations are concerned, which is clearly visible from this slide. So we've actually seen a compression on valuations. Now this compression has 2 factors associated to it. One key factor is how cost of capital has behaved, and we've seen a sharp increase in global cost of capital. That in turn has impacted our segment of the market, which is high quality, high growth. As we zoom out and look ahead, we are probably closer to the peak as far as interest rates are concerned. Our expectation is at some stage, you will start to see reduction in interest rates, which in turn will mean that there is a scope of re-rating that can happen for the portfolio. When we are constructing or when we look at this portfolio from a more internal perspective, we are still very focused on bottoms up ideas which can deliver earnings growth, because our expectation is that the positive of a lower interest rate that will play out over its own course, and we do not factor that in when we look at how we expect recovery to happen or delivery to happen as far as this portfolio is concerned. A second factor has been a fact that volume has been tepid as far as particularly last 1.5 years is concerned. You had a FY23 which had a more volatility of operating profit margins, primarily driven by how commodities behaved. You have an FY24 where we've actually seen volumes remain subdued, barring one part of the market, which is more capex led. Our expectation is that as earnings become more broad-based, or as the economic growth becomes more broad-based, with consumer discretionary picking up, you will actually start to see volume recovery happen, along with which you will see operating leverage play out, which in turn will mean that operating profits growth will outpace revenue growth for the portfolio as well. With a fillip, as far as the global cost of capital, our expectation is you will also witness some degree of re-rating as we move ahead from here on from a more medium term perspective. So that's it from my end. I will probably take a pause here. I will hand it over to Ramakrishna to take questions that you may have.
Yeah, thank you so much, Chetan, for your detailed updation on emerging opportunities portfolio and how the quarter gone by. Participants, request you to post your questions in chat box or Q&A session, so that I will curate and ask the questions to the Chetan, and we will get the answers from him. So meanwhile, Chetan, we are also collected a lot of questions from our partner friends, channel partner friends. So the most of the partners asking the one question that, in terms of our emerging opportunities fund, which we have launched in AIF platform. So it is in terms of returns, it is giving 7% XIRR at this point in time for the client's portfolio. Since we have launched the portfolio, it's been 2.5 years at this point in time. So how do you see going forward in terms of the last ground, and how do you able to generate the alpha for the particular portfolio from here on? Seeing the mid and small cap valuations already, we have seen that in elevated levels.
So Ramakrishna, like I pointed out when I was taking everyone through the presentation, so what has happened is clearly there is a pocket of the market which has remained weak in terms of delivery of earnings, primarily given by how short-term cycles are behaving within the more structural long-term upward cycle. That has meant that that particular pocket has seen one, miss in earnings, two, a fair degree of derating that has happened there as well. The second bit is that as we look ahead from a more earnings perspective, our expectation is that that pocket should start to see a faster recovery as far as earnings are concerned. So our expectation is that earnings recovery will continue. What we witnessed in the last three fiscals as well is while the performance has been lower than the benchmark and a large gap opened up, particularly in FY23 to begin with, what we've actually witnessed is the fact that operating profit growth has remained broadly in line with what we are expecting for the portfolio. We've not seen a commensurate return as far as that operating profit is concerned. While these things typically play out with the lead and lag, our expectation is that in this period, while we were seeing earnings growth, you had a second factor which was leading to derating, which was cost of capital. As we look ahead, the earnings growth trajectory continues to remain strong for the portfolio with a tailwind on re-rating, which will happen from cost of capital. If you were to even assume that interest rates remain where they are, probably, and you don't get that tailwind to play out, our expectation is you will get compensated for earnings growth plus the quality of earnings growth that we are witnessing. So if we were to look at the portfolio psychography, it's not just the quantum of earnings growth that we expect in FY25. Our expectation is ROCs for the portfolio as a whole will also start to move up. That is primarily driven by the fact that pockets which have been a drag for us, that have been pockets where capex has continued, and that capex today is not generating revenue commensurate with the expenditure that has happened. As that volume starts to flow through, you will actually start to see an improvement in ROC for the portfolio as a whole, because that capex that has got deployed starts to get utilized and starts to add to operating profit. So not only will the earnings growth happen, you will also see quality of earnings growth also improve. What this in turn means that the improvement in quality of growth itself should provide a lever for re-rating as that plays out. Plus, the commensurate compensation for the recovery or the delivery of earnings growth for the last three fiscals should also happen as we move ahead. So our expectation from this portfolio as we look ahead clearly is that we expect 14 to 15% kind of compounding that should happen after the kind of returns that we witnessed here. This is assuming you don't get any tailwind from cost of capital. Very difficult to ascertain when that will happen, but if that happens, that adds on as far as performance is concerned. Now, when we look at alpha generation over the benchmark, clearly one pocket, which is 10% of the benchmark, has done significantly well, which is the PSU bracket. That has gone up by approximately 75-76% in this fiscal. If we were to break that performance, there is a fair degree of contribution that has happened, particularly on the banking side of the PSU exposure, that has done significantly well. If we look at that, our expectation is you have already seen a very fast normalization in ROEs here. From here on, the delivery on earnings growth becomes a function of ROEs. We see limited levers available there for a large part of that market to actually deliver a faster earnings growth. You will have businesses which are today broadly in a range of anywhere between 0.9 to 1 ROA. That has historically been a peak where they've operated. And you see in the commensurate improvement as far as the adjusted price to book is concerned. At that ROA, these businesses will deliver anywhere between 12 to 13% kind of ROE at this point of time. As we look ahead, you will probably see an impact of normalization of credit cost playing out there. That in turn means that our part of the portfolio which continued to deliver on earnings growth but did not see commensurate returns will still continue to deliver on earnings growth with a higher ROE. That in turn means that this part of the market should now start to participate, which has largely remained a drag. Having said that, within PSUs, what we've essentially done is where we've increased exposure is clearly pockets within PSUs where we believe the growth remains higher for a longer period of time. So we've actually taken exposure on the defense side of PSUs where we believe that policy impetus will continue. That in turn will mean that growth there will remain elevated. Not only indigenization or sourcing from India, but there is an opportunity of India also at some stage starting to export out to other countries. Because if you look at the global defense environment or the sector as a whole, you essentially have a very large dominant presence of US, Russia, and France as far as the defense industry is concerned globally. If you were to look at what is happening there, clearly is given the two wars that are happening in Europe, you're actually seeing a lot of capacities being diverted towards those wars as far as Russia, US, and France is concerned. That in turn means that the other nations will have to look for an alternate source to increase their procurement. And that is where indigenization will help as far as India is concerned. Not only is it an opportunity from a more domestic perspective, at some stage exports will also start to contribute. So that is why we've been very particular when we've chosen the exposure there. Even when you look at the exposure that we've taken in REC, that is an indirect exposure on where we believe the capex will happen more on the thermal power side. After a very long lull period of good 4 to 5 years, where we were actually seeing very low tendering on the thermal side, what we've witnessed is capacity utilizations there have inched up. That in turn means that thermal capacities have to be added, uh, particularly from a base load perspective. So our expectation is that over the course of next 6 years, you can actually see close to 80,000 megawatt of tendering that can happen on the thermal side. This compares with a 25,000 megawatt tendering that has happened over the course of last 5 to 6 years. So that clearly means that that side of the ecosystem will also benefit. Our exposure to REC is an indirect exposure as far as the power exposure is concerned from a portfolio perspective. The third bit of exposure that we've taken is more on the OMC side. Even there, our expectation is that structurally, given the capexes that have happened, you will actually see a higher GRM compared to what we've seen in the past decades. There are a combination of factors. One is complexity adding to GRMs. The second bit is to do with the fact that globally refining capacities have been run down, which in turn means that as oil demand continues to remain stable, so pre-COVID, we were at a global consumption number of 100 million barrels per day. As we stand today, the expectation is that it will be closer to 102, while the expectation some time back was that this will start to go down. So that has not happened. Contrary to that, you've actually seen 1 or 2% increase as far as oil demand is concerned. While refining capacities have seen a fair degree of rejig, that means that supply side on the refining is where a bottleneck can come through, and that should provide a fillip as far as GRM is concerned. The third bit is on the marketing side, which is a very profitable business. There was wide fear that as state elections happened, you would see some policy intervention. What we witnessed is there have been no policy interventions there, and most of the OMCs have been allowed to retain or recoup losses of last year by a higher marketing margin of this year. Our expectation is the policy will continue to remain favorable there, and that has also meant that there is a re-rating there. So we've actually participated there. So as we look ahead, our sense is that you've seen a very large outperformance from PSUs. There are certain pockets there which may not have too much leg of very fast return delivery. So that part of the market should now start to see normalized return delivery. While the part of the market where we were present to a certain extent saw a drag because of the short-term negative cycle, that should start to turn favorable as we look ahead into fiscal 25. That is where we expect the return delivery to start to pick up. So that those are the pockets where we believe the alpha generation will happen as we look ahead. If we get a faster tailwind on cost of capital, you will actually see a faster delivery as far as the catch-up on returns is concerned. But we do not factor that in because those are macros which are not under our control. What we can control is one, the portfolio construct to deliver growth and to deliver quality of earnings growth, because that we believe is the combination for a higher re-rating as well. And what we witnessed over the course of the last two fiscals is a fair degree of de-rating as far as our portfolio is concerned. So you actually have a support of quality of earnings improving, which should provide re-rating, plus whenever the global macro plays out as far as cost of capital is concerned.
Thank you, Chetan, for your detailed answer on the performance and way forward of the portfolio alpha generation. To continue that, so you mentioned that PSUs we have increased the allocation from nil to approximately to 12%. So most of the people are saying that, already we have seen the rally in that particular segment as a PSU as a sector. How do you see this sector going forward? Whether you're able to sustain that particular rally, and how these things will impact on our portfolio returns for going forward?
So, like I just mentioned, that as we look ahead, there were pockets which delivered faster earnings on the PSU side, particularly on the banking side, because of normalization in ROEs. Our sense is that to a fair extent has played out. There can still be delivery that will happen, particularly the likes of some of the larger banks like an SBI or a BOB, which still has some room to go, given their ROEs, because their ROEs are upwards of 15%. So to that extent, there can be some degree of room there, and those are the pockets which we would like to participate. That is where REC also fits in. But as a pack, our sense is that we've seen fair degree of re-rating there. At a point in time, they were significantly neglected. We've actually seen a reverse play out. But from a more medium to long-term perspective, our sense is the ingredients of return delivery clearly remains growth and ROC. And that is what we've kept in focus as we build exposure there as well on PSUs, that we've taken very calibrated exposure there, where we believe that this combination is still available in order to build positions there, as opposed to building positions across the board in PSUs. We still continue to evaluate names there. Wherever we think this character exists, we will probably increase allocation on the PSU side, but we'll continue to remain selective as far as the PSUs are concerned.
Yeah, thank you. To continue on that same thing, one of the participants asked that while you mentioned on the PSUs, you mentioned the defense, so which is inherently as a PSU, most of companies, but other sectors that you could like to target, which are the other sectors you're looking into the PSUs? That was the question one of the participants asked.
So on PSUs, what we are essentially doing is we are being very focused on what meets our investment philosophy. So irrespective of sector, so like the three names that we have, one is an OMC, one is defense, one is on the lending side. So clearly we are being very focused on the names within PSUs that we want to populate. If we zoom out a bit and look at what we are trying to do in the portfolio today, is there are three things that clearly stand out. One is we believe manufacturing as a theme will play out over a medium to long term. So that is a focus area for us. So we continue to we continue to increase allocation there. So any PSU also which fits our philosophy and is linked to that particular theme, we will look to participate there. The second bit is more on the consumer discretionary side. So within consumption, we've been overweight consumer discretionary. That is a pocket where we've essentially increased some degree of weight. While as we look ahead, I think given the environment that we are in, there are opportunities that are available there. We would like to capitalize on those opportunities, because what we witnessed is in a structural theme, we are actually seeing a more shorter run down cycle, which has meant that as earnings delivery has been lower than expected, we've seen some degree of correction on valuations there, and there are quality businesses available there which we would like to participate. They have been on our radar, but probably valuation was a constraint that we did not participate thus far. So that is another pocket where we will increase weight, because we believe discretionary is a segment which will continue to do well within consumption. The third bit is on finance. Within finance, like I highlighted, so far we've remained very focused on more private side, granular businesses where the book is more on the retail side. What we are witnessing, given the macro, is that there will be an upward tailwind that will happen in terms of lending on the corporate side, and also on larger projects as private capex starts to pick up. So we are looking to see where can we participate, or names through which we can participate there. So something like an IndusInd Bank that we bought there, or something like an REC which we bought there, is more linked to that theme. While we will continue to focus on quality of these businesses as we build that particular exposure as well. So three themes clearly stand out. If you were to club automotive with our engineering and infrastructure exposure, so we are essentially saying that the way the portfolio is structured today is you are closer to 50% of manufacturing weight, you're closer to 20% on the consumption side, and you're closer to 20% on the finance side. So these are the three broad themes that we are trying to play through this portfolio, and identifying names which fit our philosophy and fit this particular theme where we believe earnings growth will remain accelerated for a longer period.
Thank you, Chetan. So another question came from Mr. Balasubramaniam. He's asking around the power sector. Names like Tata Power, NTPC, they have generated significant return in last 2 years. So why we are underexposed on that particular aspect? Any views on the power sector from our side?
So like I highlighted, the way we are playing the power bit right now at this point of time is indirectly through the lending side of things. That is where REC essentially fits in. Most of the utilities typically are asset heavy businesses. So that in turn means that ROCs there are lower. And we've essentially tried to play this more through the ecosystem that will deliver as far as that particular pocket is concerned. So if you have thermal capex that essentially happens or capex that happens on the power side, you see lenders that benefit, you see equipment suppliers that benefit as that plays out. So what we are trying to do is we are trying to indirectly play in the power space at this point of time. Having said that, most of these names are obviously tracked by us and are in our radar. There can be opportunities that open up, particularly on the distribution side of power, because that is where we believe the regulatory environment will start to turn more favorable as most of the discoms start to be bidded out to the private sector. So we will continue to evaluate opportunities there that can be find assets or businesses which meet our criteria as far as quality of those businesses is concerned, and can we find ways to participate there. So far, we are indirectly participating as far as the power sector is concerned.
Yeah, thank you, Naveen. So if you come to the specific questions on the stock level of what we're holding in the portfolio, businesses like Naveen Flooring, Sudarshan Chemicals, which I have done recently, and Ami Organics, especially in the chemical sector, unfortunately, these businesses are contributing, dragging the portfolio performance overall level. What is your view on the chemical sector at this point in time, especially on these three names what we have mentioned here?
So clearly, like I mentioned in the macro backdrop bit, what has happened in this particular space is three things. One is that we've actually seen inventory destocking happen because of cycle normalization post-COVID. Two, you actually saw China not deliver growth in line with what was anticipated by China to deliver, which has meant that there is a fair degree of dumping that has happened because inventories got piled up as far as China is concerned, which in turn has meant not only lower volumes for the other suppliers or the other countries who are players in that particular supply chain, but has also meant that realizations have been pulled down, which in turn has an implication of margins as well. While this was happening, given the strong inquiry pipeline, most of these companies have continued with their capex. So that means that as these capacities come on stream, you see fixed cost hitting the P&L, which further adds to the margin pressure in already an environment where you are actually seeing compression as far as realization and volume is concerned. As we look ahead, our expectation is, are we coming towards the end of the destocking cycle? What we pick up is, yes, we are probably coming more towards the end of the destocking cycle. You will start to see restocking that happens at some stage. Difficult to pinpoint and say which quarter that starts to happen, but our assessment is you're fairly close as far as the bottom of the destocking cycle is concerned. Second is, do we expect intensity from China to remain as high as it was last year? Our expectation is in certain industries, you will start to see that abating as well. That in turn will mean that realizations start gradually to inch up, which provides a further lever for margins. Third is, as you start to see the newly commissioned capacity start to contribute to revenue, you actually see operating leverage also play out, which has impacted negatively. So our assessment is, structurally, we are well positioned in this sector as a country. We continue to see higher inquiries. We continue to see capexes that continue to happen, while we have to deal with this more near-term down cycle that we are going through. So we continue to remain optimistic as far as the space is concerned, while the near-term downturn, to a certain extent, can provide the opportunity to add weights in this particular segment. There will obviously be someone who recovers faster compared to the others. So like you pointed out, Sudarshan, that was a name which was hit harder before these guys got impacted. So you're actually seeing recovery there being faster now because they have gone through that cycle at their user industry end and they started to inch up. Similarly, our expectation is for something like a Naveen or a Nami Organics that should start to recover. Naveen has had an added complication of what we witnessed in terms of top management churn there. So there, our expectation is at some stage you will see an appointment that happens there. Clearly, where they are today in terms of their journey, they need someone who's technically sound, as a lot of capexes come on stream. So those capexes have to be commissioned well within the parameters that were envisaged for those particular capacities. So that again is an opportunity and a risk. So if you don't see delivery of those capexes in line with what is anticipated, that can become a further drag. Our expectation is that the company remains capable. They have a strong second line, which has been built up over a period of time. That means that as the tide turns, you will actually start to see execution pick up there. So FY25 second half is where we expect recovery to start gaining momentum because most of the customers for these companies are still pointing towards a subdued first calendar year half. That means June of 24. So the expectation is as that plays out and as you start to see the customers turning a corner, you will start to see these entities also starting to turn a corner, which in turn will mean that from a more medium to long term perspective, what we expected from the sector, increase in wallet share globally, that will start to play out because capacities are coming on stream. Plus the fact that this significantly subdued realization environment also starts to.
Yeah, thank you. So there's a question from the participant on the banking stock, AU Small Finance Bank. So he's mentioning that it is again the underperformance given the headwinds of banking sector in terms of deposit mobilization and etc. So he's asking that is there any review of such exposures what we are having at this point in time, and can we not look into a banks where write-backs are happening and these are moving up from bottoms? So that was the question a participant has mentioned. Can you have view on that?
So rightly pointed out, I think what we've essentially seen is, particularly ever since HDFC Bank reported the third quarter numbers, is the fact that there is a fair degree of pressure as far as deposits are concerned. That has got exacerbated by the fact that HDFC needs to mobilize a larger sum of the incremental deposits. That has meant that deposits itself are witnessing a pressure there. Second factor that has played out is more seasonal. So you've actually seen a system move from a surplus to a deficit. As we look ahead, our expectation is the system level liquidity itself should start to improve. Having said that, the way cost of funds have gone up, that will obviously play out into the fiscal year of 25. So we will actually see NIM compression. That in turn will mean that NII growth will track lower than the loan growth. The lever then available is cost to income. And that is a lever which most of these entities will have to use in order to drive earnings growth. If we were to step back a bit from a more FY25 perspective and move or see the picture from a more medium term perspective, we will probably head into a scenario where in FY26, you will be behind the span of NIM compression. And then you will largely start to track along the loan growth that happens as far as NII is concerned. So if there are rate cuts that happen, you will continue. So currently, what we are expecting is there will be some rate cuts in 25. So 25 will see some degree of pain of that rate cut as well. That lingers on for a bit in 26, post which cost to income during this period starts to act as a lever. As we stretch this out, you will probably see for most of these entities which have invested heavily in branch expansion on the digital footprint side, you will actually see cost to income, which is today elevated. So from an AU's perspective, cost to income today is upwards of 60%, which ideally, if they are to achieve scale based on the investments that they've made, that should start to track lower, closer to 55%. So that in turn itself is a lever as far as ROA is concerned and ROE is concerned. So today we are in a situation where we are probably navigating through this similar short-term environment of where things are playing out from a NIM perspective. Having said that, I think we are closely evaluating opportunities where we believe that not only a short-term driver of write back of earnings or write back of provision should drive earning growth, but structurally, can we find businesses which are 15-16% ROE, driven by a more operating metric delivery or driven by the advantages that they've built over a period of time? and where we can find valuations which are more supportive and we can build exposure there. So we have certain names. We continue to evaluate those names at some stage. Probably you will see some of those names finding space in the portfolio. REC is probably first step in that direction. What we've done in this period is we've actually reduced some bit of exposure on AU. That is how you see our finance weight also in the portfolio go down from 22, 23% to closer to 18.5, 19%. So we've actually reduced some weight there in this particular name as we try to optimize this particular exposure. So the way we are envisaging the finance exposure for us is what will play out from a more medium to long term perspective is one clearly is corporate re-leveraging. So we had witnessed a corporate deleveraging cycle, particularly in COVID and post that. You should start to see corporate re-leveraging that will happen, driven by private capex that happens as we look ahead. So can we find opportunities there? We've taken certain actions there. We'll probably look at some more actions there. Second is within the entire PSU banking exposure, can we find names which have structurally improved performance and not just driven by write-backs that are more one-time kind of a phenomena? And can we find names there which have structurally 15-16% ROEs and valuations where we feel comfortable participating in those particular names? So that is a pocket that we continue to evaluate and see what we need to do. REC is one step. We'll probably, you will see some more actions as far as that particular pocket is concerned. So from a financial exposure perspective, our view is so far the story was largely about retail driving growth, particularly the nature of unsecured. What we are essentially witnessing on that particular front is that there has been a fair degree of faster growth on the unsecured side. To that extent, the regulator has also taken cognizance of that and increased risk weights there. So our sense is any franchise which is more on the retail side has been built on structural competitive advantages will maneuver this particular pressure of increase in RWA better and in turn will probably find a wider space to grow faster as the other entities start to scale back given how risk weights have behaved. So we will continue to have exposure there and probably look at building exposure there. Two, the entire corporate lending side of things where we believe loan growth will continue to pick up. And that in turn is a pocket where if we can find names which are more levered towards that side of the market and have structural cost advantages to deal with any short-term variations that can happen, particularly on the interest rate side.
Yeah, sure. Thank you. So there is another question coming from the distributor partners that in terms of Page Industries exposure. So in the past recent calls, where we have shown the conviction on the business, on their results and all the things and outcome fairly good. But now at this point in time, you are currently exited from the Page Industries. Well, the stock is beaten down very badly at this point in time. So what is your take on that and why you have shift the thing in terms of exit call for the Page Industries?
So Page Industries, primarily if you were to talk absolutely, do we like Page Industries in terms of business model? Ramakrishna, you're not audible, or am I not audible?
Yeah, Chetan, you can go ahead.
You can go ahead, yeah.
So on Page, do we like that business in absolute terms? The answer is yes. They have strong moats which they've built over a period of time. They have a great business that they've built over a period of time. They've moved into adjacencies, continued to add size of opportunity for them, which has meant that growth has remained elevated for a longer period of time. Our action is primarily more relative. Like I was mentioning, that the current environment has seen some degree of pain on consumer discretionary. So the idea was, can we optimize the portfolio based on the available opportunities that were there compared to a Page in the portfolio. And that is where we've essentially exited out of Page. The idea clearly is not that we don't like Page. The idea is, can we optimize the exposure on consumer discretionary side? Are we finding better opportunities within the available set of companies that we look at? So that has primarily been the reason of an action that given the subdued environment, we have certain names which were strong, which are equally strong businesses, probably now available at valuations which are more closer to our comfort. And we've actually relatively taken a call of where we want to move that exposure.
Okay. So Chetan, so another question is coming frequently from the distributor partners in the ground that in terms of mid-cap ITs, so where in the market we have seen companies like Sand, KPIT, Proforge, Persistent Technologies, so on and so forth. So they have delivered good returns over a period of longer time from 1, 2, 3, 5-year basis kind of thing. So do you feel we missed that opportunity? And what is your take on mid-cap ITs at this point in time?
No, so clearly, I think our exposure on IT was limited to Infosys as far as this portfolio is concerned. What has played out is obviously earnings growth have been muted there, while we are actually seeing an expectation or anticipation on recovery, which is driving stock prices there today, currently. Have we missed the mid-cap IT bit? The answer clearly is yes. We've missed the mid-cap IT bit because our expectation was you will see a similar kind of slowdown that can happen on the mid-cap IT side as well. What has hindsight played out is that there were certain industries that they were exposed to which have not witnessed this kind of slowdown. So if you were to talk about something like a KPIT, which is more exposed towards automotive, or a Tata Elxsi, which is more exposed towards automotive, that pocket has not seen slowdown in spend because of the disruption that we are witnessing as far as energy transition is concerned. That has meant that their budgets have not been cut and they've continued to deliver on growth. So that is a pocket which we've clearly missed out on. What we are doing there also is similar to the other pockets. Can we still find names from the available set where we can probably populate and participate there? So we continue to remain focused there. Some of these names, particularly on the mid-cap IT side, are at valuations where we are not comfortable. So that has kept us away as far as participating from them is concerned. While growth delivery has been in line with what was better than what we had anticipated a year back, but probably in line with what we were expecting from them in this particular fiscal. So we are still looking for names and opportunities where we believe that valuations are more within our comfort zone to participate. In a nutshell, yes, we've missed the opportunity on mid-cap IT. That has hurt us as far as performance is concerned. While the IT exposure that we had was more on the large-cap IT side, which has played out negative.
Thanks for the genuine answer. So one more question came from Mr. Balasubramaniam again. So he's asking the question on the Reliance Industries. Last couple of weeks, Reliance Industries, obviously we have seen the shot up from 2,200 to 2,900 at this point in time. So he's mentioning that it seems EOP has exited. Given your inclination for GRMs in OMCs, this is not an exposure worth re-looking at again?
No, so it obviously always continues to remain in our radar. The reason why we exited Reliance was we wanted to build IOC. So I think hindsight that has also delivered decent returns for us as far as that exposure is concerned. Looking ahead from a more Reliance perspective, our census triggers there are more linked towards the geo bit of business and the retail business as far as valuation is concerned on Reliance. So from a Reliance's perspective, the entire O2C business, which is their oil and gas business, is not a large contributor to value. A larger piece of value contributor is more on geo and the retail bit. So for geo, we had a direct exposure in Bharti, which has done well as far as the telecom exposure in the portfolio is concerned. And retail bit is a second leg, which is what Reliance gets you exposed to. So the way we've played it is from an oil and gas business perspective, we've built an IOC into the portfolio. From a more telecom exposure of Reliance, we've actually built Bharti into the portfolio.
Okay, thank you.
While we continue to obviously watch Reliance very closely.
Watch Reliance, yeah. Great, great. Thank you so much for that answer. So if I ask you another question on the stock, what we're holding at this point in time in the portfolio, which is Polycab. So we have witnessed, there are some news coming in the market that there are some IP rights, some 1,000 crores of cash transaction happened in a particular aspect. So what is your action on that? Are we trimming any positions from Polycab, and what is your view on the Polycab for that matter?
So from a business perspective, very clearly they have certain strengths, and which is why we are seeing the kind of earnings delivery that has happened on Polycab. They had capacities while the other players were capacity constrained. They have a decent exposure on the capex-led opportunities. That is where a lot of volume growth has happened, and that is what has benefited Polycab as well. So structurally, they've benefited from that. Given what has happened in terms of the notices that have probably gone out to them, our understanding is that these inquiries span over a course of last 5 to 6 years. So that means that number has to be seen in parallels with the revenue there. While that is an adverse event that has happened, we continue to monitor developments there closely. But from a pure business perspective, our sense is this is a strong franchise that has been built. We've actually seen earnings growth remain strong there. Our expectation is while for a quarter you will probably see some degree of impact of earnings growth because of the disruption that would have happened to operation. They should probably get back to the trajectory of earnings delivery uh, as far as the business is concerned. As far as the corporate event is concerned, or the event on the ED side is concerned, we are monitoring it closely. So we've kept it under close radar as far as watch is concerned. But from a business perspective, our sense is there can be some impact of this event, particularly in the Q4 numbers, because you had lost few days as that event was playing out. But our expectation is they should get back to their expected trajectory of growth.
Yeah,
and we
thanks for
wait
that.
for more outcomes as
So
far as that particular event is concerned.
thanks, Chetan, for that. So till now, we are looking on the stocks which are not contributed to the portfolios. But if you look, there are some names where we have added in the portfolio which has significantly contributed to the overall portfolio returns. Companies like HBL Power System, Ramakrishna Forgings, Bharat Dynamics, and etc. So what's your take, and can you please throw some more light on these businesses, how these businesses contributed more returns to the overall portfolio?
So like I mentioned, while we were building these names in the portfolio, and even as we look at the portfolio, is that there are three underlying themes that we believe will continue to play from a more medium-term perspective. So if you were to look at that from that perspective, clearly most of these names fit into those three themes largely, particularly on the manufacturing side, as far as the name cited by you are concerned. So our expectation is this will continue to do well from a more medium to long-term perspective. These are businesses which are superior businesses in that particular space, exposed to the right kind of sectors. And our sense is so something like an HBL Power has probably surprised us also as far as earnings delivery is concerned. Earnings delivery has been better than what we were anticipating as far as HBL is concerned. For Bharat Dynamics, the order book buildup has been probably tad bit better than what we were anticipating, and that is why you've seen the kind of delivery there. RK Forging clearly is exposed to not only the MHCV cycle here or the export market, it is also more of an engineering exposure where we are actually seeing strong structural tailwinds where a lot of particularly US and European OEMs are actually looking to outsource their business away from US and Europe because US has a clear issue of higher labor cost that has cropped up, particularly post the UAW strike that happened. So hourly wages there have negotiated upwards of $25. So that means that becomes a constraint. In Europe, you already have a structural issue of energy cost. So that means most of these businesses are actually looking to outsource and looking for partners. And that is where someone like an RK Forging fits in. So our sense is RK Forging will continue to remain a play of one, volume growth, two, increase in wallet share of customers, three, addition of customers and products. So that is how we expect earnings delivery to happen for RK Forging. So these will be four key drivers as far as delivery is concerned. So our sense is some of these names, they've actually delivered better than what we were expecting in terms of earnings or order book. And that is why we've seen the kind of delivery that has happened on earnings, on the returns for these particular names.
Yeah, fantastic. So there is one question from a participant by name Bhavik Shah, asking on the artificial intelligence. What is your take on AI and electrical consumer products such as vehicles and AI consumer appliances, etc.? Is there any names or segment we are looking into our portfolios in current situation?
So there our sense very clearly is what we are witnessing both not only in India or even globally also is fact that devices are becoming more connected, be it your consumer durables or be it even your vehicles, something like a PV or a two-wheeler, everything is becoming all the more connected. Software is playing a larger part of all of these ecosystems that are evolving. So clearly, the idea is can we identify names there which are either directly contributing to that or indirectly contributing to that. So the endeavor remains to continue to find names, something like a just to share an example, something like a Sona BLW, which is a part of the portfolio, that is probably at the forefront as far as that technology disruption is concerned. So they have made a couple of acquisitions which are more linked towards the software side of business. So our sense is you will actually see companies which are ahead of the curve within our portfolios also continue to make these right kind of exposures or take these right kind of exposures, which in turn will help accelerate earnings growth or the size of opportunity itself for these businesses, which will provide a longer runway for growth for these businesses. So clearly, there is a trend which is more towards connected devices. Today, you have an ecosystem which is getting built because so far uh, the hardware on this side was not very closely linked to software, but that is a demand that is cropping up. That will mean that there will be work for someone on the IT services side who can probably develop or have this capability to develop these solutions to their customers. You will also have players like Sona who would want to integrate this into their hardware and provide that to the OEMs as a product, which in turn can be passed on to the consumers. While on the pure OEM side, our expectation is there will always be people who are early adopters, which will be ahead of the curve. There will then be players who will probably copy that consumer pattern and trend and get into that. But in that entire evolution, suppliers of this particular pocket should benefit, and we are focusing if we can find opportunities in that particular pocket. Some of our names in the portfolio have that capability or are building that capability. So they will naturally contribute to that piece of exposure as well.
Yeah. So due to time capacity, we will take a couple of questions now. The question for Bajaj Finance. Yeah. So will Bajaj Finance continue to command the PE going forward, given the competition and headwinds in unsecured loans? So with Geo Financial coming into the market, and are you tracking on that particular aspect? There's a question from.
So yes, we are tracking Geo closely. That is a big player there that needs to be tracked closely. But if you were to just zoom out a bit and think about it, clearly the fact is that unsecured or retail lending still remains a lower penetration category itself. So as the country becomes richer, you will see leverage going up. So today we are talking about unsecured at closer to 13 lakh crore as far as the industry is concerned, which is closer to 17-18% of the industry. At a household level itself, if you were to remove mortgages, even with mortgages, the household leverage in country is much lower than where the other countries are. If we were to strip out mortgage, we'll probably be even lower as far as leverage is concerned. So our expectation is that as the country becomes richer, as these businesses penetrate into the tier 2, tier 3, tier 4 cities, the opportunity size itself is quite large. So today when we are talking about Bajaj, Bajaj says that we have close to 8 crore customers. So that clearly points towards after such a stupendous CAGR growth on loan book, you are still saying that the number of customers which they've serviced is only 8 crore, out of which active would be closer to 5 to 6 crores. So opportunity itself remains quite large. So our sense is that yes, we are monitoring the big guy who's entering into this ecosystem, but clearly there is long way to go as far as leverage itself is concerned. So our sense is that pie will continue to expand itself. Having said that, I think what the entire risk weight adjustment does is that businesses which are fundamentally built on competitive strengths will be able to pass on the impact of increase in risk weight, which in turn will mean that the likes of Bajaj, for them, environment improves. So, that clearly points towards after such a stupendous CAGR growth on loan book, you are still saying that the number of customers which they've serviced is only 8 crore, out of which active would be closer to 5 to 6 crores. So opportunity itself remains quite large. So our sense is that yes, we are monitoring the big guy who's entering into this ecosystem, but clearly there is long way to go as far as leverage itself is concerned. So our sense is that pie will continue to expand itself. Having said that, I think what the entire risk weight adjustment does is that businesses which are fundamentally built on competitive strengths will be able to pass on the impact of increase in risk weight, which in turn will mean that the likes of Bajaj, for them, environment improves. So if you were to just look back into the entire 2018 event that played out, particularly post ILNFS, what that event essentially did was that in turn skewed the growth towards companies which had managed their underwriting capabilities well, while the other part suffered as far as loan growth is concerned. You actually saw loan growth accelerating for entities like Bajaj Finance. Our expectation is even this event will probably benefit people who have a competitive advantage, which will mean that loan growth remains accelerated for these players and they will continue to benefit from this environment. From a Bajaj perspective, our sense is they still have levers in place to deliver upwards of 20% earnings growth. If they deliver upwards of 20% earnings growth, there is some degree of catch up to do, because we've actually seen a derating in Bajaj, while earnings delivery has been probably better than what was built in for Bajaj at the start of this year. So our sense is that given their underwriting capability, given the opportunity that is available to them and growth that they can deliver, the valuation should sustain here. What you should get from here is probably earnings growth in terms of return, with some degree of improvement in cost of capital. You can get some degree of re-rating as well. That is primarily driven by the fact that we've actually seen 2 years of de-rating. So there can be some degree of catch-up while we monitor the competitive environment very closely to see what is happening there.
Sure. Thank you, Chetan. Final question for the day from the Q&A chat session is that, people are asking that, timeline for
Hello.
The recovery of the portfolios going forward. Any timeline you want to give? So those will not give that timeline kind of thing, but yeah.
So I think timing this is very difficult. What we are more focused towards is getting the earnings delivery right, probably improving the construct of the portfolio, strengthening the portfolio as far as quality of earnings delivery is concerned. Our expectation is, like even for this fiscal, when we were sitting somewhere around February and March, I don't think any of us anticipated this kind of return delivery from the market itself. And it has happened the way it has happened. So our sense is, if we were to stick to the core and basics right, I think the market will reward. It's very difficult to time it. But the idea continues to remain, how can we strengthen the portfolio so that it's positioned well to deliver that kind of return.
Absolutely. Thank you so much, Chetan, for that. Thank you so much, participants, for your patient listening. And thank you, Chetan, for you to detailed update on the overall portfolio and answer all the queries of the investors. Participants, if you have any questions not answered in this particular call, I request all of you to write an email to our email ID, customer service email ID, ce@askpms.in. Or you can reach out to the local relationship managers. You can always write it to local relationship managers in the ground. Chetan, if you want to add any final remark, or we can close the call at this point.
No, I think in summary, the fact is expect earnings to recover, expect re-rating to happen at some stage, and we should get compensation for the earnings delivery that has happened. So that will probably be the only summary. Pockets which were headwind this year, our expectation is they will turn to tailwind next year, because these are structural themes. So we will actually see a benefit of that play. So that is about it from our side. Thank you everyone for joining us for this particular call. Looking forward to such interactions in future as well. Thank you. Thank you, Ramakrishna.
Yeah, thank you so much. And we will end the call today. Thank you so much, participants, for your participation.